Okay, we now dive into our very last sort of section of the class. And this is when we're going to go into the Great Depression and then go into fiscal and monetary policy, and that's how we end things up. To do the Great Depression, though, we have to really take a look at banks. And when I say banks, I specifically mean commercial banks, or the banks that you and I might encounter to make loans. How do banks make money? Yeah, go ahead.
Would it be collecting interest? Or
Yeah. So elaborate. What do you mean?
When someone takes out a loan, there would be a certain interest rate, and they will have to add that onto like their monthly or period of payment.
Yeah, right. Like you take out a loan, you pay interest to the bank and that's notable. We have to identify how they make money because if we think about the other side, how many of you have money in a bank? Right, many of you do. Some maybe a little, maybe a lot. Your college students maybe not that much, but having money in a bank is really handy. Why is having money in a bank really handy? Yeah, it's safe and it's insured. We'll talk about insured later. What else? Yeah, center. It's what? Oh, sure. Yeah, right. So speaking broadly, it's convenient, right? Like you need money, you can go ahead and get it. And you don't have to worry about it being stolen from you. If you have cash, but that's like cash in your house, right? That's obviously a risk. You could lose it. Here it keeps track of everything. And also on top of that, not only is it safe, it's in a vault or in some sort of digital vault. Not only is it easy, you can pay things digitally. You can set up automatic payment on bills. You can get direct deposit with your work. You also get interest. They pay you. Right? These things are so great. You think that you would have to pay them, but they indeed pay you. And why? And how do they make money? How do they pay for all this stuff? They earn interest on loans. So keep in mind, just as interests are an expense for the bank, interests are also the income for the bank. Banks are okay. Let's do it this way. So let's imagine, for example, you're getting 2% from your bank, and the bank might be charging 6%. So now all of a sudden, this deal that you have with your bank seems really bad. Because if I'm borrowing money from a bank, I'm paying 6%. Wouldn't it be great if I was paying 3%? If I'm getting money from the bank, I'm getting 2%. Wouldn't it be better if I'm getting 3 or 4%? Why not just cut out the middleman? The borrowers are better off at 4, and the savers are better off at 4. So why do we have banks? Because they're just kind of in the way. Yeah.
Managing and collecting on loans takes a lot.
That managing collecting loans takes a lot of work. Yeah. You have to figure out how to get people to pay you. And there's another side of that too.
Individuals aren't as resilient to bad debt, having to collect on bad debt.
Yeah, but you're talking about the collection part. So, and the collection part is really hard and important. And we want banks to be able to, we want someone to specialize in that. But think about what happens before any collection.
Yeah,
You know what? You gotta vet them. Yeah, what do you mean?
I check their credit score, credit history, income, residence.
Yeah, exactly. We have a before and after kind of problems, right? Before we send out any loans, we have to figure out if this is an individual we want to make a loan to. And then after we send out that loan, we have to figure out how to get the money out of the person, right? And they don't just skip town. So as a general rule of economics, whenever you see somebody in the middle and think, oh, would it be great if we cut off the middleman? Stop and ask yourself, why is the middleman there in the first place? Usually it's there because they perform a function. And the function of banks is that they are what we call financial intermediaries. they connect savers and borrowers. If you're a saver, you have extra cash that you do not need right now, but you would like it to work for you. You want it to be safe, you want it to be easy to use, but you also want it to do something, to earn some interest. And if you are a borrower, you need money. You want to make some sort of big payment now. And banks help you do that. Especially because a lot of savers have small amounts of money to set aside, while borrowers typically want large checks. And so it's not like if you have $50 and you have $100 and you have $35 and you have 5,000, that nobody wants to borrow $35. No one even wants to borrow $5,000. $5,000 is still not that big of a loan. People typically want to borrow 50, 500, 5 million, 50,000, 500,000, 5 million and more. Okay. So when you put money into the bank then takes that money and it loans it out. Oh, what the fuck? I just gave you that money. And you said, Santiago, it was you that said the money is liquid, right? What the hell? It's not liquid because I gave the money to the bank, and the bank is like, thanks, and they just sent it out again. How can I get my money? How do you say this liquid? Right? It's not liquid anymore. What's going on?
They give you some asset money.
Yeah. Right? In other words, when they lend out the money, do they lend out all of the money I gave them? No. They lend out most of it, but they keep a fraction. This is called fractional reserve banking. Banks lend out most, but not all of the deposit. And so they have this giant pile of cash, and they will take most of that pile of cash and lend it out as much as they can. And then the remaining they keep to cover withdrawals. So I like to create a little diagram to illustrate this. And you get a sense of what managing a bank is like. I'll make it look like Scrooge McDuck's money did, even though, like, that never made any sense to me. You know who Scrooge McDuck is, right? This is okay, check. Scrooge McDuck. Who's Scrooge McDuck?
Oh, isn't that black duck?
No, that's Daffy Duck. This is basic stuff. Come on. Yeah. Who's Scrooge McDuck? Question is, who is Scrooge McDuck? From DuckTales.
Oh, he's the father.
He's not the father, he's Uncle Scrooge. So, but in the DuckTales lore, Scrooge McDuck is really, really old. Presumably he made his money like gold mining. I think back in like the California gold rush, but I don't know, ducks live a long time, I guess, whatever. And he has this giant pile of money that he keeps in his money bin that he swims in, right? That's the guy who swims in the money. And every time I watch this show, I'm like, this is such bad finances. What the hell are you doing? You should be putting that money in the bank so it can lend out money and work for him. It never made any sense to me. Because real rich people take their money and they use it to make more money. And they put the money in the bank. And money flows into the bank in two different ways, and money flows out of the bank in two different ways. What are the two different ways money flows into the bank? Deposits and withdrawals are not money flowing into, but you're right, money flowing out. And transfers. So transfers are just going to be like, that can be a description of what's happening. loan payments. Because the transfer could just be a withdrawal, right? Taking money out of this bank and putting it in another bank. And the money flowing out is new loans. And bank management is fundamentally about managing this balance. Because there's only one of these four things that you directly control. It's this one. It's the new loans. Banks will decide to issue new loans or not. Or if you want to call it new investments. If you want to generalize it. They might set payments amounts, but they don't necessarily control if people actually pay it or not. They certainly don't control when people put money in. There's reliability, right? People get regular paychecks and do direct deposit, but they technically don't control that. And they technically don't control when people decide to take money out either. You can close your account whenever you want. Different accounts might have different restrictions, but if it's a basic checking account, you can close that out and put your money elsewhere today if you want. And they can't stop you because it's your money. That's all right. So we have a problem. Is that because there's just a small amount of money to capture the large amount of actual requirements that they have, those liabilities that they have. What happens if everyone tries to withdraw at the same time? Yeah, the bank collapses. Let's imagine that we are in some small town, and for reasons that will become clear, I'm going to go back 100 years and say this is like 1925. And I am sitting there and I'm talking to Anthony, who runs the local bank, and Anthony comes into my bar one day and is looking to get really wasted. And I say to myself, "Ooh, Anthony, what's troubling you?" And they're like, "I don't want to talk about it." I'm like, "Is it like your wife? It's not my wife. It's not my kids. It's just like, I don't want to talk about it." Now, I have money in Anthony's bank, and what might I be concerned about? He's being all cagey. He's in a really bad mood. What? Yeah. Like maybe he's stressed out and pissed off because he made a bunch of bad loans. And those loan payments have dried up. And he's concerned the bank is going to collapse. And I might say, you know what, Anthony, just take some of that and go ahead and drink. And I'm going to take a little break. And I am going to go. And where do you think I'm going to go? I'm going to take my money out of the bank, right? It's like, oh, there's only a little bit there, right? You can't cover everything. Now, other people who are in my bar are going to note that I have suddenly left after talking to Anthony, who looks a little drunk already. What might you do? Might follow me, because you might think also, oh, he's going to go get his money out of the bank. Maybe I should too. And you see me walk, and I'm going to get there before you. What do? You start running. I see you run. What do? I start running, right? Hence the term, a bank run. A bank run is when everyone tries to withdraw money out of the bank at the same time, causing the bank to collapse. It doesn't have to literally be everyone. You can say too many people, right? But at the same time. That's why I picked the 20s. This happened a lot in the 1920s. Hint, this is why I talk about this before we talk about the Great Depression. This happened a great deal. Bank runs were pretty common, especially because, note, in this scenario, I don't know if the bank is actually bad or not. What if, as we are screaming at Anthony's bank and we're saying, we need our money, we need our money, we need our money, And then we start pulling out the money, and there's a panic, everyone's freaking out. And then Anthony comes out of the bar bewildered, and he's like, "What are you guys talking about?" And we're like, "You made a bunch of bad loans, that's why you're upset." We're like, "No, I'm not. I'm upset because my dog died." I'm like, oh, it's awkward. You can have a bank fail just because of a rumor. It was a precarious time. Now, I used to say, you don't have to worry about bank runs anymore. And why did I say that? You mentioned it, the FDIC. So, in the aftermath of the many bank failures that occurred during the Great Depression, the United States government created the FDIC, which you know stands for what? Corporation. But yes, that was excellent. Usually people have trouble getting even the F part. Federal Deposit. Corporation. And the FDIC insures deposits up to $250,000. Okay. What does that mean? What do you mean insures deposits? What does that mean in practice? I want to get somebody new. Okay, go ahead. Oh, sorry. Yeah, go ahead. Yep, exactly. The FDIC is an insurance company, and every bank pays insurance premiums on each account that they have. And then the FDIC will has this giant block of money, and if your bank fails, God forbid, they will write you a check, and you'll be made whole, and you do not have to worry. If Anthony's bank fails, well, that sucks for you. I'll pour you another, but my money is safe. Now I used to say you don't have to worry about bank runs anymore because of the FDIC. Now I say you mostly don't have to worry about bank runs anymore. But bank runs still happened. We saw it happen. You might remember it happening. It made national news some years ago. Silicon Valley Bank, yeah. What was Silicon Valley Bank, Richard? I shouldn't say it was because it still exists, but
It's just it collapsed in 2023, I think.
2022.
And I think it was because of like rising interest rates or something like that.
Mm-hmm. Yeah. So we can dissect a little bit of how it collapsed. But the basic story is, remember when I said these new loans could be investments? We can think of them as investments. Silicon Valley Bank made a lot of investments in lending the government money. And then interest rates went up. And so the loans that it made at a lower interest rate were suddenly not worth very much. Because if you're going to lend the government money, you want a higher interest rate than a lower one. Why would anyone want to buy these assets that have a lower interest rate locked in? So it's like plummeted. And lots of people said, ooh, this is a problem. And so we got to see, and you can Google articles about this. And it talks about this is a bank run, what a bank run looks like in a digital era. People do not run to the bank anymore. They reach for their phones. Try? They're going to say, oh my goodness, I heard the Silicon Valley Bank is not doing well. They had a meeting of the board, and like they're not really sure that they're solvent anymore, and they have these issues with these assets, but the asset value is plummeted. Let's take our money out. Now, why do you think that they cared? So, because but aren't they insured?
Yeah, but still a hassle.
No, that's not the issue. because they were racing, they were freaking out, right?
Yeah,
Yeah, what's Silicon Valley Bank? What's Silicon Valley known for?
exactly.
So what happened? Well, what happened in Silicon Valley is you want to start some tech company. An investor will give you a giant check and say, okay, and it's not like a novelty check. Say, okay, you need to start your business. You need to get your programmers programming. You need to do what you need to do. Here's, a few million. Get started. Well, I'm a business person. I'm focused on making the business work, making the idea function. That's my core competency. And I'm like, I don't know, where should I put this money? And they would always reckon, I don't know, Silicon Valley Bank handles a lot of this kind of stuff. Just put your money there. And they would use their Silicon Valley Bank account to pay their workers, right? To pay things off, to pay for the equipment. Just write the check from there. Which meant a lot of these accounts were way over that 250 limit. Way over. %94 of their deposits were not insured. And it gets worse for Silicon Valley Bank because not only was this becoming an issue, right? Their assets were losing value, but those higher interest rates meant people did not want to cut checks anymore to startups. And thus, new startups were not forming. And thus, new deposits were not happening. Pre-existing companies suddenly saw like their angel investors saying, this is a great idea, guys. I hope it works out, but I know you need some more money to expand. I'm going to hold off on that for now. And people who had these promising ideas got a lot of no's. Because why would you roll the dice with some crazy idea when interest rates are really high? You can just put it in a bank and have it cook and make a lot of money risk-free or virtually risk-free. And so this is why Silicon Valley collapsed. And this is why we saw a bank run. And this is because the vast majority were uninsured. And we saw the whole thing play out again. Yeah.
Has it been sort of the de facto policy of the FDIC recently to cover the full
Yeah. That's the other part of this. So I used to say up to 250,000. Now I have to say up to 250,000 or more because there was such a concern about the nature of the financial industry. And this is going to be a theme that we will talk about as we go into the Great Depression. But there was such a genuine concern that people were like, is my money safe in banks? Might banking fail? That the FDIC, as a way to reassure the population, says, you know what, even if for all your entrepreneurs who are over that 250 limit, we're going to give you the full amount. We're just going to give you all the money. It's fine. It's fine. Because they wanted people to maintain the faith of these banks, not just the banking system as a whole, but also these relatively small banks like Silicon Valley Bank. Because if they said, oh, you know what, screw you, you're not going to make your money, and you're out completely, the vast majority of your business, sorry, not sorry. Then anyone in the future who says, I have this giant check, and I need to put it somewhere, where are you going to do? The big banks, right? The ones that won't fail. Which means you might end up inadvertently creating a concentration in the industry. Because people will, like these big players, will not want to bank at medium-sized banks. They're only going to bank at really big banks. And then specialized banks like Silicon Valley Bank can't function. Yeah. It was taken over by the FDIC to sort of like sort itself out. Last I checked, it still exists. It's operating small. I don't know if it's been returned back to private hands yet. I have to check the news on that. This has been operated by other things lately. But as last I checked, it still exists. Okay.
sold the first.
It's sold?
Sold the first.
Oh, okay. So still exists in some form, right? In other words, oh wait, we got concentration of the industry. I don't know how big First Citizens Bank is. It sounds familiar.
First line on all their websites is that we are open for business.
We're still here. We're still here. So we might have gotten concentration anyway, but happens when your bank fails too. Sorry. Okay. Last bit. Last bit before Great Depression. Money creation. So this is, when we talked about money creation, we typically talk in terms of the government creating money. But the vast majority of money creation is not done by the government. The vast majority of government creation happens during new loans. This is really just a matter of accounting. When a bank makes a loan, two things happen at the same time. One, it makes a new asset, the loan. At the same time, it creates a new liability, the demand deposit at the same value. Therefore, you can think of this money existing in two different places. On one hand, Fatima, you took out a loan, you have that money. You can go around, you can spend that money. At the same time, on paper, that money still exists here, right? Because it's various people's deposits. Now, all this gets squared away when you return the money, when you pay it back. But in the short run, at least, we're going to get this weirdness, this kind of money creation. So the vast majority of money that's created in the economy under normal circumstances is generated by these patterns of loans. This liability is new money. This is money creation, right? Money still exists here. Resist the temptation to freak out. That this is just a sort of thing we ought to keep in background. A lot of money creation occurs via commercial banks. And that's going to be a big theme as we go into the Great Depression. Good? Okay. So, what do you know about the Great Depression? Yeah. Give me whatever you want to do. Yep, it's the Roaring 20.
And also the wishes of Isaac, which is all these things. So I think people started taking on more loans to buy more stuff that was available. Things like maybe that's but there was a lot going on. And the banks were using that for loans from what I understand. But at the same time, maybe we weren't giving out to the best people, so they were giving it back. But then, that was more, I don't know too much, but I do know that I went for what I guess sparked the Great Depression, but I really wasn't the overall reason, was the crash of the stock market in the 1990s. That kind of spurred, that kind of was like the piano that
Yes, so we have to be careful because we typically, and I'm glad you brought up the crash in 1929. That's when we typically say that's the Great Depression. But economists and special economic historians want us to exercise caution, saying that caused the Great Depression. As an example, sometimes we expect it to rain, and therefore we bring umbrellas. And when we bring umbrellas, it later rains. We would not say that us bringing umbrellas caused it to rain. We would say we knew it was going to rain, so we brought umbrellas, right? We were forward-looking. And it's the same thing with the stock market crash. And this is, there's a lot of conversation in the economic sphere of exactly the Great Depression is like one of the most studied intermediaries economic history. But people saw there was a problem coming. That's why the stock market flashed. So it was more of an indicator of a problem. But it is a good, useful starting point. When we talk about the Great Depression, we're going to talk, and there's going to be two questions we're going to ask. We're going to answer today. Actually, let's just do three. Let's frame it this way. How bad was it? What caused it? And why was it international? Because this was not something that was limited to the United States. This was worldwide. This was a massive decline in economics. So that's what we're going to do today. Yeah. Oh, it was really bad. Okay. So let's start with the basics. How bad was it? We'll talk about how bad it was. Very, very bad, right? That's why I called it a depression, right? Not a recession. This was not some normal time. This was really bad. Unemployment peaked at about 20%. In the first few years, GDP fell by about 24%, so almost a quarter in those first few years. This was a huge decline. This is, if you look at historic data, you can always see where the Great Depression is. And this wasn't something like the COVID recession was fast. Oh, that was over quickly. How long did the Great Depression last?
10 years.
Yeah, roughly 10 years, right? So if we go 1929 to around 1939, there's debates on exactly when it ended. But a 10-year time, it's a pretty good, that's really long. That's just the decline, right? There was a little bit of this, it's rough, right? It kind of goes up and then goes down again. But that was a really shitty time. Another question that we'll answer, I don't think we're going to answer it right now, but another, maybe not today, maybe next time, is why did it last so long? Why did it take 10 years to get out of this thing? But I think it's going to take enough time. How am I doing on time? Yeah, we're going to cover that next time. I want to focus on what caused it. Okay. So, this is where things get wild. Yeah. Understanding the nature and causes of the Great Depression requires us to understand why it was a global event, and that requires us to understand the goal statement. What is the gold standard? Yeah. Mm-hmm. Yeah. Not all currencies were backed by gold this time. Spain's currency was not, for example, but most currencies were backed by gold. And by backed by gold, what do we mean? They're representative currencies. Well, thus, well, they're going to want to say all currencies, but thus all economies, almost all economies, most economies, because again, it wasn't all currencies, but were linked through gold. If the price of gold went up, then that's going to be felt on all currencies. It's a global market. So, what ultimately caused then the Great Depression, and I'll explain why all this fits together, don't worry. I'm just going to give you a preview. There's a decline in the money supply. It was not greedy capitalists. It was not bad investments, though bad investment story sometimes crops up. It was ultimately a decline in the money supply. By the way, the work that I'm focusing on when we talk about like what caused the Great Depression, decline in the money supply. This is name Milton Friedman was mentioned last class. This is Milton Friedman's thing. There's a book called The Monetary History of the United States. It says what caused the Great Depression? It was the money supply. Who do we blame for that? It was the Federal Reserve. If you want the short version. So let's see, how do I want to do this? Because I've been thinking about changing how I do this because it's like kind of gets like a complicated story. So what actually happened? So do I want to make this simpler? Did I make this? Or did I just stick with the? No. I just want to do the. Okay. If you reduce the money supply, what do you think happens to the price level? Goes up or down? Down. Yeah, 50% chance, right? If you decline the money supply, AD shifts to the left. You get a lower price level. Well, and thus we got deflation. So here's what happened. In the 1920s, two countries started buying a bunch of gold. And they bought this gold in order to shoulder in order to beef up the value of their currency. They were the United States and France. They did it for different reasons. I think I mentioned in the notes why they were doing this crazy thing. But safe to say, like the United States was concerned about people over speculating the stock market, and France had these weird rules that you just had to have a lot of currency. You had a lot of gold if you're going to have a lot of currency. I think I want to say what percent? What percent? Oh, here we go. I thought I had, yeah. About half of all of the gold in the world would be owned by these two countries. Half. Other countries largely. So basically what you do is like if you have a gold standard, you're like, hey, you want US dollars? You gotta give us some gold. And so what people would do is they'd say, okay, I'm in the UK, I have these pounds, I don't want US pounds anymore. I don't want British pounds anymore. I want dollars. So I'm going to go to the banks in the UK and give them gold. I'll give them dollars to get gold. And take this gold over to the United States, give it to them, and get dollars instead. And then I take these dollars and put them in US banks to earn these really high interest rates. Federal Reserve raises these interest rates in order to attract all this gold. but they did not issue a lot more currency. Remember, currency can be issued more than once for the same amount of gold. So if somebody got $1 million for some gold that they gave them, the bank did not issue any more than that. They could have issued more, they didn't. We don't really know why. As a result, the price of gold started going up. But that's weird, because by law, in the United States, 1 ounce of gold was $20.67. This wasn't a price control. This is just what defined a dollar. Because again, you don't want to carry gold around. It's annoying. So if you can't really increase the price of gold, to reflect that, the price of everything else fell. That effectively makes gold more valuable. This is how everything unraveled. I don't have this one in my notes, but I'm thinking about printing that. I wasn't sure how deep I wanted to get into it, but it is pretty fun. I want to make sure I got all my stuff that I want to give you the background. I'm kind of scattered right here. I get that. I just want to give you a little bit of background and then kind of go over it again because this is a confusing time. All right, bank panics were unusual, major recession. Okay. So right off the bat, if we want to talk about what caused the Great Depression, we started buying a bunch of gold and the money supply fell. We did not issue more money. France had these weird rules that says you couldn't issue more money, and the United States just decided not to issue more money. There was concerns that they had some sort of constraints. The Federal Reserve had some sort of constraints as well, political constraints. They were concerned about the stock market being overvalued. They're like, we're not going to issue more money. We're going to keep interest rates high. We're not going to issue more money. Thus, the money supply fell, and now we're in kind of a problem. That in of itself is not going to cause a depression. That's a correction. That's bad. The economic area declined. Here's how things got worse. So, the money supply falls. Actually, I'm going to this fucking slide. I'm going to put it right here. Yeah, right. That causes the price level to fall. Oh, wait. Remember what we talked about? When the price level goes up, when there's inflation, who is that good for? The borrowers. Right? The borrowers, right? So, if there is deflation, who is it bad for? The borrowers. Because you owe the same amount of money, but you are making less. Does anyone know what region of the United States the Great Depression started? The Midwest. Yeah. Why the Midwest? What's in the Midwest? As someone who's from the Midwest, I take a little issue with saying there's nothing in there, though you're kind of right. But it's not desert. The Midwest is known for its corn, yeah. Agriculture, right? Before the agriculture. Fun fact: in Iowa, where I grew up in, there are more pigs than people. Yeah, fun fact. We are known for our corn, and we do grow a lot of corn. A lot of the corn that we grow, we feed to our pigs. I didn't personally grow up on a farm, but this is mine. I have family who were farmers. Many families were farmers. Wait. Where does corn come from? No, potatoes come from Idaho. How do you grow corn? Begins with an S? Seeds. If you buying some seeds at a store, not a big deal. Buying seeds for hundreds of acres of farmland, that's expensive. And so what people would do, and this was a standard thing people did, is they would borrow money. To buy seeds. This is where we get the term seed money from. Yeah.
There also like drought, dust bowl.
The Dust Bowl, yeah, the Dust Bowl would happen though after the Great Depression started, right? But it is going to make things worse. Smoot-Hawley tariffs too made things worse. But Smoot-Hawley tariffs were not there wasn't a lot of trade as there is now. So both of those things are aggravators, but they are sideshows. We borrow money for seeds. We then plant. We then harvest. We sell. And then we pay off the loan. And we're going to do that over, and that was the pattern. And then the next year we borrow more money for seeds. That's what farmers did. Except the problem is the price level just fell by quite a bit. Remember, deflation is bad for borrowers. What happens? Yeah, we're going to default. Defaults go up. Hey, wait. If defaults go up, what happens to bank failures? Yeah. They can't cover their deposits, right? Because remember, this was the 1920s. Remember how we talked about how important it is to diversify? You could not diversify so easily. There were rules, and just a lot of more people were farmers. So, yeah, so go ahead.
Well, I was just gonna say, is it like, so if price level going down means that the farmers will receive less money to be more available? Is that
Yeah. So the price level goes down. That means the price of food is going down. Yeah. So you can't pay off. Exactly. I can't pay off my loan anymore. I thought I could. I can't. Defaults go up. Bank failures go up as well. And guess what we talked about? Most money is made through new loans. If banks fail, no new loans. Therefore, the money supply will fall even more. And around we went. At first, people did not think that the recession, the depression, it was just a recession, that would be a big deal. Banks fail. This happens. There's occasionally panics. That's a problem. But as the years progressed, it got worse and worse. And you can see the bank failures spread out of the Midwest like this cascading fungus that's taking over everything. Something like 40% of U.S. banks would fail in those first few years. U.S. banks. As deflation deepened, banks started to fail because lenders, especially farmers, defaulted. People panicked, pulled money out. We started getting bank runs, so we had more failures. Bank failures meant less money in the system. As they scare people to keep money out, thus AD shifted even more. Have you ever heard stories about people going through doing a renovation of an old house? Like a really, really old house from the 20s, and then they like pull out the drywall and they find behind the drywall there's stacks of money. That's a thing. So again, it's becoming less and less of a thing because the banks by now have been renovated. But certainly 20 years ago, this would happen, where they're doing some renovation of an old house, and then they find that there was money in the walls, in the literal walls. And the reason why is it was put there during the Great Depression, because people didn't trust banks anymore. The problem is if you take your money out of the bank, where it can be used to make loans, and you put it into the wall, it can't be lent out anymore. It's taken out of circulation. And that makes it worse. This is why prices fell by about 1/3 during the Great Depression. This is why when Silicon Valley Bank failed, President Biden was very big about trying to reassure everybody that the American banking system is sound. This is why during the Great Recession, and there were concerns that multiple major banks would fail, that the Federal Reserve stepped in, and Ben Bernanke, who was chair of the Federal Reserve at the time and student of the Great Depression, and would later win a Nobel Prize for his work on the Great Depression, said we have to save these banks because we do not want the Great Recession to turn into another Great Depression. Because when the banking system fails, it's one of those keystones in the economy. They provide a genuinely valuable function of linking savers and borrowers. And when banks fail, mass banks fail, you have a fundamental problem on your hands. And this is what turned the Great Recession into a depression. So I gave you a lot of information here, a lot of history, but this is why I kept this part up. This is the most important part. Because people ask, so how bad was it? It was really bad. What functionally caused it? It was a decline in the money supply. Why was it international? It was because of the gold standard. The gold standard linked these economies together. This was happening not just in the United States. It was happening in Argentina. It was happening in Germany. It was happening in France. It was happening in the UK. It was happening all over the world. This radical decline in the money supply brought on by a really high price of gold, massive deflation. Yeah. Well, because if the price of gold goes up, it's not going up in just the United States, it's going up everywhere. Mm-hmm. Yeah. We get that gold, right? But of course, gold itself can't literally go up because by every country's law, our currency is literally some fraction of gold, right? There's really no price at all. If the price of gold goes up, then the currency is just more valuable to match. So what happens is instead the price of everything else falls. The price of everything else falls. That makes the currency more valuable. So I know this is like a weird thing to think about because like we're not on the gold standard anymore. So let's see, I had this example to try to think about it because it also freaks me out too. Imagine you have an ounce of gold, and that gold has become more valuable because lots of people want it. They want to turn that gold into dollars or something and put it somewhere else in the bank. In normal circumstances, the price of gold would go up. And if you sold that gold, you would get more money than usual, and that would cause that money to let you buy lots of stuff. But the gold prices can't increase because money is defined as a certain amount of gold. So how are we able to have more stuff, even like we should? We make everything else cheaper. So, like goods and stuff, right? Cutting the prices of everything else. So, and imagine a bidding market where someone's like, I want that gold. and I will, give you dollars for it. Well, imagine instead someone's like, oh, I want that gold too. I don't have dollars, but I do have, like maybe flour, and I can just give you more and more flour for that gold. You can imagine, well, if you give me more and more flour for the gold, I mean, the gold buys you more flour. That's functionally the same thing as the gold prices go up. Does that make sense? Yeah. And if you're wondering, like, why are people going back and forth talking in terms of like trading commodities rather than this currency? During this time, actual dollars became quite scarce. There's a wonderful diary of the Great Depression, called A Diary of the Great Depression, and it's about someone who lived in like Indiana during the Great Depression. Is like nobody has any money. Like literally, cash is really scarce. People are trading things that I'm just trading time. Yeah, go ahead, David. So it's tricky because it kind of started in lots of different places. So I treat like certainly the Midwest was the starting point for America, but people talk about that. Well, like I think Argentina was getting some issues in 1928, and Germany was getting some issues in 1928. Germany was, of course, very precarious at the time. So it's kind of a thing that started like investing in lots of different places at once. But the U.S. was a big player then, as they are now. So disproportionately, it was the U.S.'s fault. And again, we blame the Federal Reserve. I mean, Ben Bernanke on Milton Friedman's birthday, I can't remember if it was his 80th birthday or I can't remember which birthday it was. But he had a big party. And Milton and Ben Bernanke admitted, yeah, it was our fault. Sorry. Like, you were blaming us for years, and now we're admitting it. Yeah, it was our fault. With this idea of LRAS shifting left, that's Ben Bernanke. He did a lot of work showing that you can have these structural problems as well. Okay, I gotta let you go. I will see all of you on Tuesday, where we then dive more into the Great Depression, because we haven't really talked about then. How did it last for so long? How we got out of it? We'll be talking about next time. I'll see you then.